Hey everybody, it's Tyler and Joel here with Elevation Real Estate, and today we're chatting with Jason Humeniuk of Hilltop Financial. We've had a bunch of clients asking us questions about the mortgage rates today, doing all sorts of wacky things. So we thought rather than trying to explain that ourselves, we would defer to the expert in that field. So Joel's going to ask some questions here, and we'll chat about it.
Hey Jason, how you doing?
I'm good, Joel. How about yourself?
I'm doing well. I was just trying to help out our clients who are asking me, why are the rates going up and down so crazily? I thought if the rates went down, everything went down. What's going on?
Yeah, so it's a great question, and I've been getting those questions as well from my clients. And unfortunately, it's not as easy as why are rates going up and down, specifically when it comes to mortgages, because you've got two type of rates predominantly. You've got your variable and you've got your fixed rates. And understanding that they are mutually exclusive, while there are factors that contribute to both of them both going up and going down, they don't both operate the same. So let's start into maybe demystify that a little bit and explain the difference between the two. So we'll talk about variable rates. Variable rates are based on the Bank of Canada lending rate, and actually they're based on something called the CDOR, which we won't get too much into. But basically, when you hear the Bank of Canada dropping rates, that is the overnight lending rate that the Bank of Canada will lend money out to institutions. Now, the banks have their own prime rate. On Friday, that being March 27th,
Yeah.
the Bank of Canada again made an emergency cut of 50 basis points. The banks, a couple of them did follow, which means the rest of them will follow, dropping their rates by 50 points. So the bank prime lending rate right now is 2.45%, where the Bank of Canada rate, I believe, is 0.25%. They've gone down 150 basis points, 1.5% in the last week and a bit. So the banks don't always follow the Bank of Canada. So for instance, when we were coming out of the financial crisis in 2008, there was times that the Bank of Canada cut their rate 50 basis points, but the banks only cut theirs 0.35%.
Right.
So
does that mean they're just getting greedy, or what?
Well, here, and what I'm going to do is I'll show you a quick stat that might help this a bit. So here's what's called the CDOR. So if you guys have a look here, this section here, these are what the banks lend money to each other and themselves at. Okay, so large institutions that have lines of credit, and you can see that's a lot higher than what the Bank of Canada rate is at 0.25%, but a lot lower than what they're lending money to you and I as borrowers at. And why that's important is the banks have to make their money. They want their spread over everything. And if you look at what the spread is between the prime rate and what the spread is between the rate that they lend each other off to, here you can see a little chart. So this is from January 1st, 2019 to March 28th. So this is the CDOR rate. Again, what they're lending to themselves, to other banks, or what they're lending to large institutional clients at. Typically, the banks want to see a spread anywhere between 180 basis points, so 1.8%, and 2%. So you can see here from about March of last year, they up until January of this year, they were right into their sweet spot. But then what happened is their rate went down, the CDOR went down, but then prime started to drop. And you can see their spread quickly getting away from the 200 basis points or 2% they had here to the 1.8%. So how the banks dealt with that is they still lowered their prime rates, which is great for everyone who already had a mortgage or had a line of credit or any type of variable product. But what happens is about a week and a half ago, you could get a variable mortgage at prime minus 1%. And so we had clients go in and redo their variables at prime minus 1, which is great because they now have a mortgage rate at 1.45%, which likely is going to go well into the next couple of years. So excellent for them. But for the new lending, that's gone now. Just about every lender is at prime plus. So prime plus 0.1, prime plus 0.15, and this has happened within the last 2 days, which are still great. People are walking into variable mortgages now at 2.55%, which is still an excellent rate, but it's not the prime minus one. And the reason the banks are doing that is they need to keep their spread at that 180 basis points to 200, where they need for mortgage investment. So that's why, number one, that's where you see the variable rate. So if you clients hear the Bank of Canada lowering mortgage rates or lowering their prime rate, don't automatically assume that that means your bank is going to lower their prime rate or that that's going to affect your mortgage rate. And what it definitely will not affect are fixed mortgage rates.
Right.
So fixed mortgage rates are completely different. They are priced off of the equivalent term of the Government of Canada bonds. So if you go and you buy a savings bond, you understand what the bonds are like. So here we can see the Government of Canada bond rates. So if you want to know what a fixed mortgage rate is going for, usually the banks like to see same thing, about 180 to 200 basis points spread on what the bond rate is as opposed to what they're lending it at. So if you're going to get a 2-year mortgage, they're going to want to see about 180 to 200 basis points, which would put a 2-year mortgage somewhere around 2.44, 2.45%, a 5-year mortgage somewhere around 2.6, 2.7. So now there's some other things in there as well. There's other costs to lending that's not in the spread, which we won't get off into, but you may have heard, your clients may have heard in the news recently, CMHC, the Bank of Canada, said they were going to buy a bunch of mortgages off the books of the bank. And why that's great is that the banks have those mortgages purchased by CMHC and the Bank of Canada, which then gives them back that money to lend out and put into the economy, thereby hopefully lending to businesses that need it through this time, lending to consumers that need it this time, creating liquidity within the marketplace.
Does it also lower their risk?
For sure, because all those mortgages now get insured by the government. So yeah, it completely lowers their risk, and that's no longer on the books. And then what the government does is they package up those mortgages and they sell them through what's called the Canada Mortgage Bond. And investors love that because now you've got an investment that's secured by a piece of property, but more so it's 100% guaranteed by the Government of Canada. So now they will go out and they will buy those bonds. But there's a cost for lenders to put their mortgages into what that CMB, the Canada Mortgage Bond. So that gets added on to the price of their mortgage. So right now we're in the neighborhood of, call it 2.85% to 3.2% for 5-year fixed mortgage rates, depending on whether you're refinancing or you're buying with 5% down in that CMHC insured. So they're right back where they were. Now, 1 week ago, you could get a mortgage rate if you paid the mortgage insurance. So you bought a home with less than 20% down, then it was insured by CMHC or Genworth or Canada Guarantee, the 3 insurers in Canada. You could have got a 5-year fixed rate at 2.34%.
Wow.
With no weird fine print, just typical mortgage. Today, that same mortgage, less than a week later, is 2.89%.
Yeah, substantial.
It's substantial, and that all has to do with the bounce in the bond rate. If you are going to look at, and I'll show you one more here really quickly, we're going to take a look at what that bond rate has done. So here's that 5-year bond rate. So you can see from, this is about a year ago in March, it was pretty steady around that 1.6 down to a low of, let's call it 1.2. But, you know, mostly if you draw a line right around here, it's right around that 1.5% mark. You know, lenders typically want 180 to 200 basis points, give or take. So right around 3%, 3.1, which is where rates have been over the last year. But then you see this. Here is that bond rate in March. So a couple weeks ago, the 12th of March, dropping as low as 0.46%. So what happens here and why you see this is if people are concerned about what's going on in the stock market, and obviously were with the hit that the Dow and the TSX were taking, people were scared about what was going on. So they were pulling their money out of the market. And by people, I mean not just people, I mean institutional lenders, large corporations, and they put their money, they don't want to lose principal. So they take their investments and they put it into a safe and secure Government of Canada bond, where they know they're not going to get a great return, but they're not going to lose any of their money. And
Right.
the bond is how the Government of Canada borrows money, right? So if a bunch of people want their money in Canada bonds, the government doesn't have to pay a high rate of return. It's supply and demand. A bunch of people want it. So that's why you see this massive drop in the bond yield and the price. And that's why mortgage rates dropped really quickly. But then things started to get back to a little bit normal, and that's why you see them creep back up. So a long way of saying that's why we've seen the fluctuation in mortgage rates. Now, you look at where mortgage rates are going to go long term. Again, my crystal ball is not great on the best of days, but a lot of it's going to have to do with, again, how comfortable people feel with the economy and what's going on. Because mortgage rates are priced, fixed mortgage rates are priced off those bond rates. If people feel good about the economy, like we saw the Dow and the TSX jump up again because of the packages the governments in the US and Canada put together, the stimulus that they involved. And so Wall Street and Bay Street reacted positively to that. But then what happened is now they looked at all this more information's coming out about COVID-19, and that's creating more fear. So people are like, okay, are these packages going to be enough?
Right.
Get scared again. Again, more money starts flowing into the bond, brings rates down a little bit. So as far as long-term rates go, it's really going to depend how long this COVID sticks around.
Mm-hmm.
We've been at low rates now. If you look back about 5 years ago, the 25-year average for 5-year fixed mortgages was between 5.5% and 6%. So I think anything under 5% is a great mortgage rate if you look historically, and certainly mortgage rates around 3% are amazing historically as well. And we've been in this lower rate environment now since probably for the last 10, 12 years. A little bit of spike coming out of 2008, 2007. So are you worried about rates? If you're worried, lock in. Most things cycle out within 5 years. Talk to your mortgage advisor, go take a look and say, is it time for me? Does it make sense for me to break my mortgage? Lock in now at a low rate for the next 5 years, wait that term out, wait the fluctuations in the market out, and have some stability that way. Everyone's situation is going to be unique. And so that comes down to a personal conversation.
Yeah, I guess it depends on people's risk capabilities or allowance. Some of us are okay with a floating rate and we don't think it's going to jump up much. And others are saying, I can't take that risk.
Yeah, and if I put on, again, my best fortune teller attire, I think variable rates are going to stay lower. If you've got a prime -1, I would not lock in and I would not refinance to a fixed. Again, you're paying it, not me. So to your point, Joel, I've always said, if your mortgage rate, variable rate keeps you up at night, then lock it in, because it's never worth it to have that stress and have to look at the markets each day and see what's going on. Take the cost certainty with a fixed. Having said that, in my situation right now, I write out that prime -1 because things are going to get worse probably before they get a little bit better in the markets. And as the markets start to recover, as we saw in 2008, the Bank of Canada raises slowly because they don't want to put a shock back into the market and send things into a recession. So I anticipate that we're going to be in a low variable rate. So if you've got prime minus right now, I would hang on to that for sure.
And can you touch a little bit on, I know it's been all over the news, all sorts of different stimulus and support packages that have come out from mortgage deferrals. And whatever the government's offering to help people through this crisis. Maybe get your thoughts on some of those options available and what people can do.
Yeah, absolutely. So when it comes to what the banks have offered with respects to, and not just the banks, mortgage lenders as well, just about every lender has put something in place where you can get up to a 6-month deferral. Now, keep in mind, this is not a blanket program. Not everyone's going to qualify. Not everyone will qualify. You've heard situations already of people being declined for this. And whether it's a good program for you personally or not depends on your situation. If you're at the point where you're worried that you're not going to be able to make your mortgage payment and you're going to default, absolutely. Talk to your lender, talk to your mortgage specialist, talk to your mortgage broker, and find out what options you have. But if you can avoid it, it's not something that you want to rush into. So let me give you a kind of a tangible example of this. If you make an extra payment on your mortgage each year for 5 years and you have a 25-year amortization, at the end of 5 years, instead of having a remaining amortization of 20 years, you'll have about 18 and a half years left. 17 and a half years left. So that extra payment each year for 5 years reduces your amortization by about 2.5 years total.
Wow, that's a lot.
Yeah, exactly. So again, which is why people take accelerated payments to do that, which is a great strategy for reducing your mortgage payment. But now think about the inverse of that. So now you're not making an extra payment every year, you're deferring a payment every year for 5 years, how much that adds on to the life of your mortgage. And worse than that, this program that they've talked about the banks, it's not mortgage forgiveness, it's not payment forgiveness, it's not interest forgiveness. They're deferring it, and basically that interest gets added to your principal. So now you're going to be paying interest on your principal and on the extra interest that you've now turned into principal. So at the end of your 5 years, your renewal payments could actually be higher, even if rates were lower, because your balance has gone up, not down. So it's really something that you want to think through. Again, if you are worried that you're going to miss your mortgage payment, absolutely. Talk to your people, find out if it's right for you and it makes sense for you. But don't rush into it because it may actually put you in a worse situation than better, again, depending on your personal situation.
It sounds like effectively it's just refinancing your mortgage with a higher principal amount. So if that's what you're doing at the end of the day, you might as well talk to your broker, your lender, and explore the other options available. If you're going to refinance, take the best option available.
Yeah, and that's a great point, Tyler. It all starts with a conversation. And again, you know what? Talk to your broker, talk to whoever it is that you speak with about your mortgage, and look at your situation and make sure that it's someone that is going to give you unbiased advice as much as you can get unbiased advice these days. That it's not someone selling for an institution or somewhere else, because you might look at it and it might be, you know what, we're still employed. Maybe our hours reduced, but we're still getting payments in. So maybe it comes down to a time where you look and say, look, let's lock in a low rate. Let's lock it in for the next 5 years. Let's take out a little bit of equity. Certainly here in the lower mainland, anyone who bought within the last 5 years, 4 or 5 years ago, has increased equity available. So maybe now you take some of that equity out, lock in a low rate, and put that cash aside so that you can use it for payments if you need to down the road, if things get worse, cover any deficits that you might be in. And worst case scenario, in 6 months to a year, if things are going well and you don't need it, you can use your prepayment privileges to take that money and put it back against your mortgage.
So like an emergency savings account is what you're talking about? Exactly.
And you can do that a couple ways. You can set that up through a line of credit on your mortgage that you've got access to, albeit at a higher rate. But there's a bunch of different scenarios that likely work out better than a 6-month deferral. So that's a situation where you want to talk to someone and say, okay, in my specific situation, what is the best approach for me?
Well, yeah, let's just take a scenario where somebody just lost their job. They may not be able to refinance, so they have to consider the deferral program or dig into some savings somewhere.
Yeah, absolutely. Again, it's it's not going to be for everyone, but it's definitely going to be for some people. You know, there was a survey put out last year. You know, debt's been in the news, and people's, you know, debt to income ratio, the government's debt to income ratio for the last number of years. But there was a survey that came out last year that said in the Lower Mainland, people were one paycheck away from, you know, being in a position to starting to miss payments. So there's definitely going to be a situation where the deferral makes sense for people. But talk to someone to find out.
So if somebody doesn't know somebody that's a lender or a mortgage broker, would they be able to contact you?
Yeah, absolutely. For sure. We'll put our information at the end of this video, or they can email me at info@jason.mortgage. And questions. We get questions from clients. We get questions from friends and family of clients just wanting to know. We've got 13 mortgage professionals at our office that are all licensed by the government. And I think we've got over 300 years of mortgage experience between us all. So
you don't look that old.
No, it's true. Thanks, Joel. I appreciate that. But yeah, like we have my entire week last week has been filled up with Zoom conferences and phone calls from people that have dealt with me and people that haven't, just wanting to know. I think probably have a level of security understanding, say, okay, here's my position. Is it good? Is it bad? What can I do? And we're certainly available for that, just to talk. Sometimes it's a quick conversation saying, okay, good. Now that I understand that, I can move on. So by all means, reach out and let us know.
Thanks, Jason. Appreciate your insight today. Of course, we could probably chat about this for hours, and we're never going to cover it all. The conclusion seems to be chat with somebody who knows and figure out the options that are best for you in your unique scenario. So we appreciate your input there.
Yeah, my pleasure. Thanks, guys. And thanks for having me on today. And we'll look forward to chatting soon.
Sounds good. Thanks, Jason.
Take care.
Right.